Now we know all the qualitative characteristics, we're going to look at a big trade-off or contradiction between two in particular. So the first qualitative characteristic was relevance, and the fourth one was verifiability. And look, there's others that sort of support each other. So for example, accounting entity in accounting assumptions helps support relevance, but these two are kind of in contradiction. How so? Well, let's look at them. Relevance says accounting must be relevant. What does that mean? It means it's got to be capable of making a difference to the decisions made by users by helping them make informed decisions. So it's all about decisions. Do we need this piece of information to make a good decision? And there's three tests. Is it material? Is it related to this entity? And is it related to this period? That's a little bit different to verifiability. So this one over here with relevance is all about making decisions. This one's about the information presented must be verifiable. In other words, it must have evidence. How do we get evidence? Well, we have source documents for everything. We avoid estimates, guesses, and subjectivity. And we have all our information audited by an independent party. And just looking at the definitions of the two, you can start to see there's a little bit of a contradiction here. How so? Well, let's look at some specific examples. So, sometimes a business actually has to make estimates and guesses that involve subjectivity. There's just no way around it. And the problem is there's no source document available for that. So some specific examples we're going to look at in our course are budgeting. What is that about? That's where the business needs to prepare for the future by preparing a budget. But you literally cannot prepare for the future without making estimates and guesses. You need to budget for the future to help you make good decisions, but you need to make estimates and guesses. There's a contradiction there. Asset values. Over time, the value of the assets of the business changes as times change. But how much is something worth today? Well, that involves an estimate and a guess. And the last one is goodwill. That is the value of the brand, reputation, or image of the business. But how do you even figure, how do you put a dollar value on that? Well, that involves an estimate or a guess. So let's look at each of these one at a time as good contradictions between relevance and reliability. So let's look at budgeting. When you think about it, accounting basically works by preparing financial reports about what has already happened. It's a very retrospective sort of tool, accounting. So here's a financial period. So whatever it might be, a month, a year, whatever. And the problem is, once that period ends, that's when we prepare the financial reports, income statement, cash flow statement, balance sheet. But when are we preparing them for? We're preparing them from the past. Now, these can be verified with source documents. Everything that happened there has a source document. So that's very, very verifiable, but it's not really relevant, is it? Like it helps us make decisions about the past, but it's limited in how much it can help us make decisions about the future. However, it is very, very verifiable. Now, the problem with accounting is if it only sort of allowed us to look at what's already happened, it'd be pretty useless. So the good thing about accounting is it actually does allow us to look at the future. So if we take, this is the period that just happened, period plus 1, period plus 2, period plus 3, these might be months, 6 months, years, whatever. The point is we can prepare budgets for the future about what we think will happen. But these can't be verified with source documents and they require estimates and guesses. And that is just good business practice. You should always be budgeting for the future. But the problem there is it involves totally guesses and estimates. So, what are we guessing or estimating? We're estimating how much our revenues will be, how much we think expenses will be, how much cash do we think we'll get, how much cash will we spend, what assets will we own, what liabilities we own, etc. Guesses about a lot of things. And the point is that is very, very relevant because it helps us make decisions about the future. If we think we're not going to have enough money in 3 periods' time, we can take some measures today to actually fix that. But the problem is it's not verifiable. These are all estimates and guesses. So we've got a contradiction. One's not more right than the other. We're just saying we need to be aware of it when we're preparing a budget, that it's very, very relevant, but it's not verifiable. So how do we sort of resolve this contradiction? Well, what we do is, we can get an element of verifiability by getting our guesses and estimates audited by an independent third party. So if we think sales are going to be a certain amount in the third period, that's going to be based on some sort of data, and that data can be audited by an independent third party. What about our second situation? Asset values. So does this mean because of verifiability we should never use estimates, guesses, and opinions that don't have a source document? Well, accounting would be pretty limited if that was the case. So here's the actual balance sheet for Apple from 2021. This is actually in billions. So that's $109 billion of property. Let's just take one building in particular, this building here. So within that figure, there's one building here that was built in Silicon Valley in 1995 for $2.3 million. There will be a source document that from the builder which verifies we bought a building, we got a building made for $2.3 million, very verifiable. Problem there is that figure relevant today? Over 25 years later? Nah, it's not. Silicon Valley property prices, like property prices everywhere, have grown heaps, 500% since then. So the real estimated value of that property today is $15.4 million. So should we value it at 2.3 million or 15.4? Well, relevance says one thing, verifiability says the other. To be relevant, we really need to value it at today's value, which is $15.4 million. That helps us make decisions like how much to insure the building for, should we sell it, etc. But that 1995 figure is just not relevant to the decision making today. Okay, it's just not important. It doesn't affect any decisions we make today. So, verifiability, does that mean that Apple can't just come up with this figure themselves? Of course. What must happen then is if this $15.4 million, Apple just can't come out of thin air. It's going to be an estimate, but we could get that estimate provided and audited by an independent third party, which in the real world we call that person an assessor or surveyor. So that's how we resolve the contradiction. We do need to make an estimate, but it's got to be an educated estimate. It's got to be provided by and audited by an independent third party. One more example. Goodwill. What is goodwill? Well, it's more of a business management topic, but we say it is the value of the brand, the reputation, and the image of the business. It's a legitimate and very possibly a very valuable asset for a business. Why? Well, brand name and reputation attracts customers. It develops loyal customers. They stay with us. Often allows us to charge more. And it's a good way to get people to work for you because they're attracted to the brand or reputation of the business. So these are all economic benefits or economic resources. And that is the very definition of an asset. So the question is not, is this an asset? It's more about, well, how do we value it then? So let's look at some of the most famous brands in the world. This is in 2021 from this website here. The most valuable brands in the world. The Amazon brand is worth $683 billion. We've got Apple, Google, Microsoft, Facebook, McDonald's. Nike's not on there, but that's another big brand. Okay, these values should go in the balance sheet as assets, but I guess the question is, it's very relevant. Those values about the brand, we need those values so we can, we need to calculate them so we can make informed decisions about the business. They help us make decisions about pricing, products, marketing, etc. But it's not very verifiable because they're all, involve a certain degree of estimates and subjectivity. So some businesses, do they even have goodwill? Maybe they've got negative goodwill, like as in their brand is so toxic that it's actually not only not an asset, but it's actually something that costs the business. But if it does have goodwill, how do you figure out its value? Well, and how can it be calculated, and more importantly, verified? Well, it really can't. So what we should do is we should get it audited by an independent third party. Remember, verifiability has that clause in it that says, all right, avoid estimates, but if we do have them, can you get them verified by an independent third party? And therefore, it's got to reflect the real world. Now, we look at our other qualitative characteristic for faithful representation. We can't just make up a number and say our business has goodwill of $20 billion, million, trillion. That doesn't make any sense. So it should reflect the real world. And there we sort of resolve our contradiction. We need goodwill because it is relevant to our decisions. It doesn't have verifiability. So we overcome that by getting an amount that's come from an independent third party that reflects the real world.